Ever wondered how to find stocks that offer robust dividends, have sustainable payout ratios, and demonstrate strong growth potential? Well, it's no secret that striking a balance between income, stability, and growth is critical when building a portfolio. However, navigating the vast landscape of the stock market to find these kinds of stocks can be a challenging, yet rewarding endeavor. Today, we're going to explore this fascinating topic. We'll talk about how to identify stocks that not only offer attractive dividends, but also maintain sustainable payout ratios and demonstrate strong growth prospects. To do this, we'll focus on a select group of S&P 500 stocks that meet these criteria. These stocks present a compelling investment idea that's worth considering. So, are you ready to uncover some potential gems in the stock market? Stay tuned as we delve into the specifics of these criteria and unveil some appealing S&P 500 stocks that meet them. Firstly, let's understand the criteria that help in identifying such promising stocks. Our first stop is a yield over 4%. What does this mean? Well, high-yield stocks tend to be like a beacon for income-focused investors. A yield that exceeds 4% is a strong sign that a company has the potential to provide robust dividend income, which can be a steady stream of cash flow for investors. Next, we pay attention to payout ratios. Specifically, we're looking for those below 80%. Why this number, you ask? A payout ratio that's maintained below this threshold suggests that the company still has a significant portion of its earnings to reinvest in the business. It also implies that the company has a safety net to weather economic downturns and the flexibility to sustain or even increase dividend payouts. This is an important indicator of a company's financial health and its commitment to shareholders. Our third criteria is a forward price-to-earnings, or PE, ratio below 15. This is an important metric for investors, as it can provide insight into whether a stock is reasonably priced. A forward PE ratio below 15 indicates that the stock may offer good value for money, which can be an attractive proposition for investors. Lastly, we're interested in companies that are expected to see earnings per share, or EPS, growth of more than 10% in 2024 and 2025. This indicates a positive outlook for the company's profitability and suggests that they have strong growth potential. Analysts' expectations of double-digit EPS growth are a promising sign of a company's future performance. Now that we know what to look for, let's explore some stocks that meet these criteria. Our first pick is Pfizer, a well-known player in the pharmaceutical industry. This global powerhouse has been an integral part of the healthcare sector for over 150 years, and it's showing no signs of slowing down. Pfizer currently offers an attractive yield of 4.5%, making it a viable choice for income-focused investors. It's a clear demonstration of the company's commitment to share its profits with its shareholders. But what about sustainability? Pfizer maintains a payout ratio of 75%. This indicates that the company is not only returning a substantial portion of its earnings to shareholders, but also retaining a healthy amount for reinvestment and future growth. This balance is a key factor in ensuring the sustainability of dividends and the company's overall financial health. Looking at valuation, we find Pfizer's forward price-to-earnings ratio standing at 12. This suggests that the stock is reasonably priced, offering potential value for investors. In the world of investing, buying into quality businesses at fair prices is often a winning strategy. Lastly, let's talk about growth. Analysts are expecting Pfizer's earnings per share to grow by 12% in the years 2024 and 2025. This double-digit growth projection signals a positive outlook for the company's profitability, which could potentially result in price appreciation and higher dividends. So, what does this all mean for you as an investor? Pfizer not only offers an attractive yield but also maintains a conservative payout ratio, providing financial flexibility. It's reasonably priced and it's expected to deliver strong earnings growth. This combination of income and growth potential makes Pfizer a compelling investment idea. In sum, Pfizer's combination of income and growth potential makes it a worthy consideration for any portfolio. But remember, investing always comes with risks, so it's crucial to do your own research and consider your financial situation and investment goals before making any decisions. Next, we have United Parcel Services, a leading global logistics company. UPS is a familiar name, delivering packages to doors across the globe, but it also delivers when it comes to investor returns. The company boasts a yield of 4.2%. This high yield is a clear indication of the robust dividend income UPS provides, making it a compelling choice for income-focused investors. But the attractiveness of UPS doesn't stop at its yield. The company also has a payout ratio of 72%. This is well below the 80% threshold, indicating that UPS has ample room to reinvest in its business. It also suggests that the company has the financial flexibility to weather economic downturns and sustain or even increase its dividend payouts. Now let's talk about pricing. UPS trades at a forward price-to-earnings or PE ratio of 14. This is below the 15 mark, suggesting that the stock is reasonably priced. Investors looking for value may find it in UPS. Lastly, let's look at growth. Analysts forecast an earnings per share or EPS growth of 11% for UPS in 2024 and 2025. This double-digit growth rate signals a positive outlook for the company's profitability, adding another layer of attractiveness to this investment. So why is UPS a compelling investment idea? It's simple. UPS offers a high yield, has a sustainable payout ratio, trades at a reasonable forward PE ratio, and is expected to see double-digit EPS growth. This combination of income, value, and growth potential makes UPS an appealing addition to a diversified portfolio. United Parcel Services offers a balanced mix of income and potential capital appreciation, positioning it for future success. Lastly, let's take a look at KeyCorp, a prominent player in the banking sector. KeyCorp, a Fortune 500 company, is a regional bank based out of Cleveland, Ohio. It's a financial services powerhouse providing retail and commercial banking, investment management, and other services to its customers. KeyCorp's dividend yield stands at an impressive 4.8%, making it an attractive option for income-focused investors. This high yield is a testament to KeyCorp's commitment to return value to its shareholders. When we examine the payout ratio, it's at 78%, just below our threshold. This suggests that while KeyCorp is generous in its dividend distribution, it's also mindful of maintaining financial flexibility. This balance allows the company to reinvest in its operations, weather economic downturns, and sustain or even increase dividend payouts in the future. Now, let's factor in the forward price-to-earnings ratio, which is at 13. This is indicative of a stock that is reasonably priced, offering potential value for investors. In other words, KeyCorp's shares could be considered a bargain, given its earnings potential. Speaking of potential, analysts have a positive outlook for KeyCorp's profitability, expecting a double-digit earnings per share growth of 14% in 2024 and 2025. This forecast suggests that KeyCorp is on a trajectory of increasing profitability, which could lead to higher dividends and a potential appreciation in its stock price. So why is KeyCorp a compelling investment idea? It's simple. KeyCorp's high yield, coupled with a manageable payout ratio, provides a steady income stream for investors. Its reasonable forward PE ratio suggests that the stock is undervalued, presenting a potential opportunity for capital appreciation. And the expected EPS growth signals a strong outlook for the company's profitability. With its high yield and robust expected EPS growth, KeyCorp is an enticing prospect for investors. It's a stock that combines income, stability, and growth potential, making it a worthy consideration for a well-rounded investment portfolio. In summary, these are just 3 examples of S&P 500 stocks that meet our select criteria. Pfizer, with its attractive yield and conservative payout ratio, offers financial flexibility and a solid growth outlook. United Parcel Services, with a sustainable dividend policy and a reasonable forward PE ratio, provides a balanced mix of income and potential capital appreciation. KeyCorp's high yield and robust expected EPS growth make it a compelling prospect for both income seekers and growth investors. These investment ideas underscore the value of a well-rounded portfolio that combines income, stability, and growth. However, each investor's financial goals and risk tolerance are unique. Therefore, it's crucial to conduct thorough due diligence before making any investment decisions. Remember, the right balance between income, stability, and growth can make all the difference in your investment journey. Happy investing!